Special Reports is a daily show that will cover issues surrounding the economic collapse. All our reports and daily alert news are backed up by source links. We work very hard to bring you the facts, and we research everything before presenting the report. Subscribe for latest on financial crisis, oil price, global economic collapse, dollar collapse, gold, silver, Bitcoin, global reset, new world order, economic collapse, economic news, political, geopolitical news. Today, we talk about the crisis in Turkey is being caused by the U.S. Fed. The chart above shows the value of everything on the U.S. Federal Reserve's balance sheet since the 2008 crisis. This, basically, is how the Fed rescued the global economy. It bought $4.8 trillion in bonds and other assets. Those purchases showered the planet with $4.8 trillion in cash. Some of it probably went into your paycheck. It was rescue money, basically. That little dip in the line this year, right near the end. That's the Fed beginning its long reversal. The global economy is now growing nicely. It does not need to be rescued. So it is starting to sell those assets, taking all that cash back. America is not alone. The European Central Bank is tapering off the increases in its balance sheet too. After September, there will be no more new rescue euros. In Britain, the Bank of England has started increasing its interest rate, another way of gathering cash. The rescue sterling are going back into the vault too. The rescue money is saying bye-bye. That little dip doesn't look like much, but it represents a coming reduction of $600 billion annually, according to Russ Mould, Ajbel's investment director. Here is a close-up of the Fed's balance sheet from 2015 to today. That looks a lot more dramatic, doesn't it? Now you can see why it is causing so much trouble in the global currency markets. The narrative around Turkey and the crash of the lira is that this is a dispute between U.S. President Donald Trump and Turkish President Recep Tayyip Erdogan over tariffs on steel and aluminum, and whether the Turks should release a U.S. pastor under house arrest. But neither of those issues is big enough to wipe 40% off the value of the lira. The backdrop, the real driver, is the Fed's balance sheet. As the Fed takes in dollars, it reduces the supply of those dollars globally. The value of each dollar goes up as the supply declines. A relative appreciation in dollars is the same as a relative depreciation for everyone else. That is what you see on the chart below from Finvits. In dollar terms, most other currencies are taking a big hit. Turkey has suffered more than everyone else, a 40% collapse in the lira, because its economy was built on high levels of deficit spending and external debt. That works when times are good. If your own currency is gaining in value, then it becomes easier over time to pay off debts in foreign currencies. And it tempts you to take on more of this ever cheaper debt. You can keep an economy roaring along with that stuff. And Turkey was roaring, with 7% gross domestic product growth, compared with 2% or 3% in the US and UK. But while the Turks were enjoying their economic miracle, their gross external debt reached $466 billion, about 60% of GDP, according to the Bank of America Merrill Lynch analyst Farhan Salman. The global tide of cash is receding. With the global tide of cash receding, and the scarcer dollar going up, it is now much more difficult for Turkey to obtain the money it needs to pay its debts and finance its government spending. The cost of Turkey's dollar-denominated debt is going through the roof as the lira plunges. This is the tipping point. This is why you're hearing a lot about contagion in emerging markets, small foreign countries, basically, and currency crises. This is why the Australian dollar is taking so many hits. The country does a lot of trade with China, Asia, and all those other Pacific nations. The Australian economy is a train. There has not been a recession down under in 26 years. But it's using the wrong dollar, so its currency now looks like this. This is how recessions start. Economies that are doing just fine suddenly discover that their currency is no longer valuable enough to pay their bills. Recessions start like this. If one country can't pay its debts, people start pulling out of other countries like them. This chart from Deutsche Bank shows you the global effect of that little dip we talked about earlier. You'll notice that Turkey is actually the second country to be derailed by the strong dollar. Argentina has been grappling with a currency crisis all year. Who's next? Russia and Brazil are on the weak end of that chart, and they are major economies. The last time something like this happened was the Russian financial crisis of 1998, in which the entire country defaulted on its debt. adding those two to the crisis list would be serious. It is not yet clear whether we are going to see a repeat of the emerging markets crises of the late 1990s. These things are not guaranteed. Perhaps this time it will be different. But look again at that first chart of the Fed's balance sheet. The reason this is a truly scary moment in economics is that we've already got Argentina and Turkey scrambling, and the Fed has only just begun. There is a long, long way to go. Why the Federal Reserve is as much to blame for Turkey's economic crisis as Donald Trump. It is necessary to point to the Fed's actions to understand tremors in world markets, but central bankers should never have been held solely responsible for the restoration of macroeconomic stability. Beware the dog days of August, wherein last week, President Trump roiled currency and European equity markets with a shock announcement that the U.S. would double tariffs on Turkish steel and aluminium. It was a move that caused Turkey's already weakened currency to fall off a cliff on Friday, and threatens wider turmoil. On one of 2007's August dog days, the Swiss bank UBS announced that assets on its balance sheet could not be valued fairly, and therefore investors would not be allowed to withdraw funds. This shock caused interbank lending across the world to freeze, and central banks to intervene with massive injections of liquidity. It began the slow-motion rollout of the global financial crisis of 2007-9, which peaked with the bankruptcy of Lehman in September 2008. A crisis that so far is without end. While President Trump's latest foreign policy moves are typically unpredictable and aggressive, they are not alone responsible for global financial turbulence. Blame can also be allocated to the more sedate and discreet, but equally disruptive, policy moves of the U.S. Federal Reserve. For 6 years after November 2008, the Fed, along with other central banks, took a dominant role in stabilizing the global financial crisis. Orthodox economists had advocated a path of monetary radicalism and fiscal conservatism. Politicians obliged, and so, central bankers began to purchase and place on their balance sheets treasuries and mortgage-backed securities owned by banks teetering on the edge of bankruptcy. Central banks became, in the words of Mark Carney, the only game in town. The Fed lowered its policy interest rate from 5.25% in September 2007 to 0.25% in December 2008 and quadrupled its balance sheet from less than $900 BN, 700 BN, in 2008 to roughly $4.5 trillion by 2014. At this point, tapering of its quantitative easing program began. Today's financial turbulence can be traced back to Fed decisions in June 2017 to begin the normalization of its balance sheet, gradually shedding its bond holdings in monthly stages. This monthly runoff of $10 BN of maturing assets onto capital markets causes bond prices to fall and yields to rise. On some estimates, the Fed's bond portfolio is expected to shrink by $315 BN in 2018 and $437 BN in 2019. This process of normalization is no simple and stable matter. In the words of market analyst Christina Huber, it's like defusing a bomb. To add to the strains caused by the runoff of assets, in June 2018, the Fed raised rates for the 7th time in 3 years and Libor followed suit. These rising rates of interest have led to the strengthening of the dollar and capital flight from emerging markets. But above all, interest rate rises pose a threat to the heavily indebted global economy. In 2000, the stock of global private and public debt amounted to $142 trillion, 260% of global GDP, or income. Today, 10 years after the credit bubble at the heart of the GFC has nearly doubled to $247 trillion, or 318% of global GDP. Much of that debt is a result of the Federal Reserve's largesse. Thanks to capital mobility, quantitative easing enabled companies, like many based in Turkey, to borrow in dollars on the international capital markets at low rates of interest. Now, as Turkey's currency and those of other emerging markets fall, the cost of servicing debt denominated in dollars rises dramatically, threatening default. But while it is necessary to point to the Fed's actions to understand tremors in world markets and to warn of the threat of another financial crisis, the fact is that central bankers should never have alone been held responsible for the restoration of macroeconomic stability. That was a task to be shared between the wielders of both fiscal and monetary policy. While the US's fiscal stimulus was greater than the Eurozone's, it nevertheless embarked on austerity after 2011. The Eurozone had already determined to impose austerity in 2010. Governments and treasuries effectively sat on their hands as the global financial crisis rolled on. As a result, recovery from the crisis has been elusive. It is the inadequate and lopsided nature of the orthodox economic response to the global financial crisis that has prolonged the global financial crisis for 10 years, and that threatens another global financial eruption. Above all, it is the orthodox economic response that has prevented discussion, debate, and action that would have resulted in the re-regulation and restructuring of the global financial system. After the 1929 financial crisis, Keynes in 1931 and Roosevelt in 1933 got a grip, and as Eric Rauchway explains in his book The Moneymakers, jointly began the process of ending the gold standard and radically restructuring the global financial system to restore not just macroeconomic stability, but, after 1945, a golden age in economics. Today, we are once again threatened by global financial turmoil. This may be the time to ditch economic orthodoxy and revive the radical and revolutionary monetary theory and policies of John Maynard Keynes. Or do we have to endure another global crisis before economists come to their senses? Turkey was ripe for a currency crisis. Will it spread? The hurt that President Trump laid on Turkey on August 10 was feather-light doubling of tariffs on imported Turkish steel and aluminum. Turkey sells only about $1.4 billion in primary metals to the U.S. in an average year, according to the U.S. Commerce Department. So the new levies will reduce the country's gross domestic product by just about 0.04%. And that's assuming Turkish mills and smelters have to cut prices by 25% to retain their American customers. The hit will be even less if the Turks find customers in other nations that aren't jamming it with high tariffs. So why did a 0.04% slap on the wrist, more of a tap, really cause the Turkish lira to plummet, prompt President Recep Tayyip Erdogan to complain of economic warfare, push down the currencies of Argentina, India, Indonesia, Mexico, Russia, South Africa, and Zambia, and raise Italy's borrowing costs to their highest versus Germany since May? It's simple, actually. Conditions for a crisis were ripe. Financial weakness and poor policies in Turkey and other vulnerable nations supplied right into two headstrong characters, Erdogan and Trump. Butting heads, like flint and steel, provided the spark. Countries go through stress in two ways, gradually and then suddenly. We're seeing the suddenly right now, says Sami Mawai, a Baltimore-based money manager at T. Rowe Price Group, who manages the Emerging Markets Corporate Bond Fund. The currency crisis is a huge blow to Erdogan, who won re-election in June. Investors grew restive after the vote when he appointed his son-in-law, Berat Albayrak, as Treasury and Finance Minister and exerted pressure on the central bank not to raise interest rates, which would have helped defend the currency and lower inflation. Now things are coming to a head. Turkish banks and non-financial businesses borrowed heavily in dollars, so the fall of the lira will sharply increase their financing costs, raising the risk that this becomes a full-blown debt crisis. The authorities need to act decisively, but history suggests that they will instead procrastinate, writes Nafez Zouk, the lead emerging markets economist at Oxford Economics in London. Erdogan has been wanton in his management of the economy. He suggests that high interest rates are the mother and father of all evil, and subscribes to a theory that increasing them causes inflation. In striving to show financial independence, the autocrat has done the opposite, raised the likelihood Turkey will eventually require assistance from the International Monetary Fund, China, or someone else. On August 14 he was reduced to threatening a boycott of IPHONES. The next day, Qatar threw him a lifeline, promising to invest $15 billion in Turkey. The strong man appears weak. For the rest of the world, the risk is contagion, the transmission of financial problems from one nation to another. Even if Turkey doesn't directly infect other countries, its troubles could instigate a general retreat from vulnerable emerging markets. Contagion is a very elusive term, says Layla Kinner, a market strategist for BNY Mellon Investment Management in New York. To be sure, contagion is not what most economists are predicting, given that Turkey accounts for only 1% of the global economy, and the market value of all Turkish companies traded on the Istanbul Stock Exchange is less than that of McDonald's Corp. The Turkey-centered crisis is likely to be milder than the emerging markets crisis of 1997-98, which began when Thailand abandoned its peg of the baht to the dollar. That episode slammed Indonesia and South Korea as well as Thailand. It also touched Hong Kong, Malaysia, and the Philippines. Since then, Asian economies have fixed their finances and built reserves of foreign currencies as cushions against a panic. The fallout this time might even turn out to be less than after the taper tantrum of 2013, when countries such as India, Indonesia, Mexico, and Poland were infected by fear that the Federal Reserve was about to taper its purchases of long-term bonds, driving up U.S. interest rates and sucking money away from emerging markets. But the crisis is still ugly for nations that are under pressure, particularly Turkey itself, whose inflation rate, 16% in July, will go even higher when the drop in the value of the lira raises import prices. The lira is down almost 40% this year. And the crisis is affecting leaders of countries who, unlike Erdogan, are trying to hew to economic orthodoxy. In South Africa, the rand's decline puts pressure on President Cyril Ramaphosa, who took office in February, on a promise to end corruption and stagnation. Likewise, in Argentina, a declining currency and rising bond yields complicate the job of President Mauricio Macri, whose market-friendly economic policies are a contrast to those of his predecessor, Cristina Fernández de Kirchner. Two lessons emerge from this episode. The first is that if you're in a small country with an economy that is open to foreign trade and investment, you should borrow cautiously and resist the temptation to borrow in foreign currencies to qualify for a slightly lower interest rate. The Institute for International Finance estimates that dollar-denominated corporate liabilities total $3.7 trillion in emerging markets, double the amount of 2010. The point is, you don't want to put yourself in a position where you depend on the kindness of strangers, especially if those strangers are people who manage billions of dollars in investments on the trading desks of New York and London. They will lavish money on you when times are good, taking advantage of the higher returns typically available in emerging and developing markets. But when the good times go bad, they will turn against you in a heartbeat, driving down the value of your currency, raising your borrowing costs, and pulling out their hot money investments. There is no sentiment on a trading desk. South Korea learned this lesson, if anything, too well. Once a borrower, it has become one of the world's biggest savers since it got scared during the Asian financial crisis. The country has a surplus on its current account, the broadest measure of trade in goods and services and investment income equal to 5% of GDP. The problem with so much saving is that South Korea, like Germany, isn't buying its fair share of the world's goods and services. Instead, it is keeping its own citizens employed in the export sector. Turkey is at the opposite end of the spectrum from South Korea. In this year's first quarter, it ran a current account deficit equal to 6.3% of GDP. That trade balance measure has been in the red every quarter, but one since the end of 2002. In other words, Turkey has been borrowing and spending beyond its means, running up a tab that is now coming due. Bloomberg Economics rates Turkey the most vulnerable of 19 emerging market economies based on 4 equally weighted criteria: the current account balance, external debt, as a share of GDP, government effectiveness, and inflation. No other country has quite the same combination of weak and deteriorating fundamentals, as well as a government sprinting away from economic orthodoxy, writes Tom Orlik, chief economist of Bloomberg Economics. The next 4 most vulnerable among the big emerging market nations are Argentina, Colombia, South Africa, and Mexico. The second lesson from this mini-crisis is that U.S. behavior continues to matter. As bad as Erdogan's leadership has been, it took a Trump tweet to turn very bad into disastrous for Turkey. The lira fell 18% the day of his tariff announcement. The tweet was something of a gift to Erdogan, because it added weight to his claim that Turkey was the victim of hostile outside forces. Trump best tweet rattled markets because U.S. presidents have sought to calm market turmoil in the past, whereas Trump intensified it. What's more, his justification for the tariffs was both murky and disconcerting. Many investors assumed the tariffs were intended to add pressure on Erdogan to release an American evangelical pastor, Andrew Brunson, from house arrest, since Trump had just finished sanctioning two Turkish government ministers over the affair. Other investors speculated that the tariffs were intended to offset the pricing advantage Turkey was getting from a cheaper currency, because in his tweet, Trump noted that their currency, the Turkish lira, slides rapidly downward against our very strong dollar. Either of those justifications could run afoul of the World Trade Organization, of which the U.S. is a founding member. 12 hours after the tweet, the White House stated, somewhat implausibly, that the real reason for the tariffs was to boost national security by protecting U.S. steel and aluminum producers, without explaining why they had been applied only to Turkey, and not bigger sources of metal imports. The American who has the most sway over emerging markets may not be Trump but Federal Reserve Chairman Jerome Powell. The Fed is raising interest rates to prevent inflationary overheating in the U.S. that pushes up interest rates all over the world as companies and governments compete for limited funds. On May 8, Powell said that the Fed wasn't primarily responsible for global flows of capital and that emerging markets were well positioned to navigate the U.S. rate hikes. Still, if an emerging markets crisis gets bad enough, Powell's Fed could dial back on rate hikes, on the grounds that it may curtail U.S. growth. Turkey is likely to remain a thorn in the of the world economy for some time to come. That is because of the two lessons of this crisis. Erdogan is ignoring the first one, about the need for sound economic management, and Trump is ignoring the second, about prudent U.S. leadership. The two heads of state, who as recently as July appeared to be best buddies, are at loggerheads. It looks like a replay of Trump's relationship with Chinese President Xi Jinping, another authoritarian whom Trump both admires and is infuriated by. Contagion, if it occurs, could happen through defaults that damage banks in lending nations. Spain's Banco Bilbao Vizcaya Argentaria, Italy's Unicredit, and France's BNP Paribas are the most exposed lenders, according to Bloomberg Intelligence. But those banks, and certainly their host nations, should be able to ride out loan losses. Shares of BBVA, the worst off, are down 12% this month and 24% so far this year. More vulnerable are Turkey's fellow debtor nations. Contagion can occur mechanically when investors lighten up positions in, say, Argentina or South Africa, to compensate for losses on Turkey, keeping their overall emerging market risk below some predetermined threshold. Or it can occur if Turkey becomes a wake-up call that leads investors to take a closer look at other nations' fundamentals and find them wanting, says Akener of BNY Mellon. And things could get worse from here. Our big worry is if Turkey really goes into a major crisis and they impose capital controls, preventing investors from getting their money out. Paul McNamara, a London-based fund manager at GAM UK Ltd, told Bloomberg Television. That's the sort of thing that brings the asset class into sort of disrepute. If prices go down too far, though, bottom fishers will surely emerge, as they always do. The volatility set off by Turkey is replete with opportunity. Jan Dane, head of research at Ashmore Group plc in London, wrote to clients on August 13. Turkey's problem is entirely self-inflicted, and it will not suddenly appear in, say, Poland or Uruguay, he added. Thanks for watching. Tell us what you think in the comments section below.